Good morning. It is Wednesday, January 28, 2026, and you are with Talk Tickers. We are the deep dive that tries to cut through all the noise and figure out what is really moving the tape.
That's the mission. And today we've got a really fascinating one on the desk. We're looking at National Bank Holdings Corporation. Ticker is NBHC.
And if you're an NBHC holder, you might be looking at your screen a little funny this morning. The stock is down, what is it, about 3.9% before the bell?
It is. And the setup here is interesting. The volume coming into this earnings print was, super light. It felt like the market was just holding its breath.
And now that the numbers are out, the exhale was, well, it was more of a groan.
A groan is right. I mean, it was not a sigh of relief.
Yeah, when I first saw the headline numbers, my first thought was just, ouch. But as I dug in, I kept coming back to one phrase, and I think you did too, kitchen sink.
That is the perfect way to frame this. This is a textbook kitchen sink quarter. For anyone listening who hasn't heard that term, it's when management decides, you know what, this quarter's already messy. So let's just throw everything in.
Everything. Every write-down, every expense, every piece of bad news. You just flush it all at once to clear the decks.
It's like I already broke my diet with one cookie, so I might as well eat the entire pizza.
Exactly that. You take all the pain now so that you can walk into 2026 with a completely clean slate. But to see why they did it, we have to look at just how ugly those headline numbers were.
Okay, let's rip the Band-Aid off. GAAP earnings per share, $0.42.
And the consensus, what the street was looking for, was 0.87 cents.
That is not a small miss. That's more than 50%.
It's a crater. And the top line didn't save them either. Revenue came in at about $100.6 million. The street wanted something like $107 million.
So you've got a revenue miss and a massive earnings miss. An algorithm sees that and just slams the sell button.
Instantly. But there is an adjusted number in there. They say non-GAAP was 0.60 cents per share if you back some things out.
Better, for sure, but still a long way from 87 cents. What's driving that gap?
It's the margins. The net interest margin, or M, dipped to 3.89%. It was almost 4% last quarter.
And management's story is that variable rate loans repriced before the Fed could cut rates.
Right, which is a common story right now. But here's the crucial detail, and you have to ask if it's just spin. They said by December, the NIM had already bounced back to 3.97%.
Okay, so is that real? Does that actually matter, or is it just them trying to make us feel better?
No, I think it matters a lot. A bank is like a giant ship. It doesn't turn instantly. So the average for the quarter was low, but they're telling you to look at the exit velocity. They're entering the new year back near that 4% level.
So the income statement is a mess, but the balance sheet, I was surprised. It looks strong, really strong.
Buff is a good word for it. Look at tangible common book value per share. It's at $27.80. That's up 10% year over year.
Can we just pause on that? Why should a listener care about tangible book value? It feels like one of those jargony terms.
It's maybe the most important metric for a bank. Think of it as the liquidation value.
Yeah.
If they sold everything and paid off all the debt, that's what's left for shareholders. It's the floor.
And growing it by double digits in a volatile year is a really big deal.
It's the gold standard. It means the underlying worth of the company is getting thicker, despite all the noise in the P&L. And their CET1 ratio, their safety cushion, is almost 15%. It's a fortress.
A fortress balance sheet, but a disastrous income statement. Which brings us back to that kitchen sink idea. Why did they miss so badly?
Okay, so we have to talk about the $10 billion asset cap. This is where it gets a little complicated.
This is the part that made my head spin. They intentionally lost money on a trade to stay small.
It sounds totally backwards, I know. But in U.S. banking, $10 billion is a regulatory cliff. Once you cross it, you get hit by something called the Durbin Amendment.
That's the one that limits the swipe fees on debit cards.
Exactly. For a bank like NBHC, crossing that line costs them about $10 million a year in lost interchange income. That's a huge penalty.
And they were getting close.
They were right on the line. So in Q4, they made a choice. They sold some securities and took a $2.6 million after-tax loss just to shrink their balance sheet and finish the year under $10 billion.
Wait, let me get this straight. They paid $2.6 million in the fourth quarter to save $10 million in 2026.
That's the trade. It looks awful on the quarterly report, but it's a trade you want them to make every single time. It's brilliant.
Okay, that explains a big chunk of the miss. But that wasn't the only thing. They also had a big provision for credit losses.
Right, a $9.1 million provision expense. That's money they're setting aside for loans they think might go bad.
And the CEO was pretty blunt about it, saying they wanted a clean slate. But does that worry you? Is their loan book getting weaker?
It's a fair question. You always have to be skeptical. But they specifically called out just 3 credits. And the timing, again, points to the kitchen sink strategy if you're already going to miss earnings because of the security sale.
You might as well take out all the other trash while you're at it.
Precisely. Get all the bad news out in one shot. Clear the decks.
So they've cleared the decks. What are they clearing the runway for? Because the whole conversation on the call shifted to this big acquisition of Vista Bank.
This is the growth engine. The deal just closed in early January. And this isn't just buying another local bank. This is a major geographic play.
They're going into Texas and Florida. We're talking Dallas, Fort Worth, Austin, Palm Beach. These are high growth markets.
Huge growth markets. And the management tone around this deal was, it was really energetic.
Energetic is one word for it. Did you catch that quote from John Steinmetz? He's the executive from Vista who's joining NBHC.
I did. It was memorable.
He was talking about the due diligence process, and he compared it to a proctology exam.
Yeah, you don't usually hear that on an earnings call. I think a few analysts probably choked on their coffee.
I definitely laughed. But what's the signal he's sending there? It's not just a joke.
No, it's a very specific signal. The biggest fear in a bank merger is that you're buying hidden credit problems. By using that very vivid metaphor, he's telling investors, we looked everywhere. We were incredibly thorough, and we like what we found. He's trying to calm those fears.
And speaking of what they're buying, they kept using this phrase, resort markets.
This is their secret sauce, I think. They're not trying to be the bank for everyone. They're building a fortress in these high-wealth enclaves. Jackson Hole, Aspen, Vail, Telluride, and now Palm Beach.
It's the Yellowstone strategy, banking the places where the super rich live.
And more importantly, where they're moving their primary residence. These aren't just vacation spots anymore. Wealthy boomers are leaving high-tax states and moving full-time. And they need a local high-touch bank.
So they're becoming the concierge banker to that migration.
That's the niche, a very, very lucrative niche.
Okay, so that's the stake, but there was also some sizzle here. Let's talk about 2UniFi. It sounds like a fintech startup hidden inside this bank.
It basically is. It's their tech play. They just finished phase 1, launching these integrated SBA working capital loans.
And the partners they listed. Finxact, Savannah, Visa, Marqeta. These are top-tier names.
They're not messing around. This is a modern tech stack, not some clunky old core from the 80s that most banks are stuck with. It lets them move much faster.
But when a bank says tech play, I usually just hear money pit. What are the economics looking like?
Well, for now, you're not wrong. They're only guiding to maybe $2 to $4 million in revenue from 2UniFi this year.
That's nothing.
It's a rounding error. And the expense run rate is about $22 million. So yes, on paper, it's a drag on earnings right now.
So why do it? Why not just cut the project and save the money?
Because of the catalyst that the CEO hinted at. He said they are targeting a partnership in 2026 that could meaningfully reduce that investment.
In plain English, what does that mean?
It means they might bring in a partner, maybe a big fintech, to share the costs. And here's the picker. That potential deal and the savings from it is not in their guidance.
Ah, so it's a free option. If the deal happens, earnings go up. If it doesn't, the bad news is already priced in.
Exactly. It's pure upside optionality.
Okay, let's look at the guidance. Because they laid out a pretty aggressive roadmap. It looks like a classic hockey stick recovery.
It really is. They're talking 10% loan growth, and NIM holding around 4%. But the wild part is the earnings projection. They think they'll exit 2026 earning over $1 per share.
Wait, hold on. They just posted an adjusted $0.60, and they're saying in 12 months they'll be at $1 per quarter.
That's the ramp they're projecting. And that sets them up for a full year number in 2027 of over $4 per share.
$4 a share. You put a normal bank multiple on that, say 10 or 12 times, you're talking about a stock in the 40s or $50.
Which is massive upside from where we are today. But you have to get through 2026 first.
Right, because 2026 is going to be expensive.
Very expensive. The expense guide is $320 to $330 million for the year. That's the cost of swallowing Vista and doing the integration.
So the market is looking at this and saying, great story for 2027, but the next 12 months look like a lot of work and a lot of bills to pay.
That's the tension. It's the jam tomorrow problem. The jam looks great, but you have to eat dry toast for a year to get it.
Management seems confident, though. They're backing it up with cash.
They are. They raised the dividend 3.2%, which is nice. But the big signal is the new share buyback. They authorized $100 million.
Doubling the old program?
Right.
Right after a kitchen sink quarter?
That tells you they think the stock is cheap. They see the negative reaction to the headline numbers, and they're ready to step in and be a buyer.
Okay, let's move to our favorite segment. This is where we throw out the spreadsheets and get creative. Standard disclaimer.
This is not financial advice. We're just having a conversation about the numbers. Please, do your own work.
Don't sue us. But if I were pitching this trade today, I wouldn't call it a bank trade. I'd call it the rich boomer migration long.
Okay, I love it. Break that down for me.
The thesis is ignore the net interest margin for a second. Just look at a map. Where are they banking? Jackson Hole, Aspen, Vail, Telluride. Now add Palm Beach and Austin.
It's the White Lotus portfolio.
It's the Yellowstone lifestyle. You're making a bet that the migration of high net worth people out of high tax states is not slowing down. Wealthy boomers are moving their primary homes to Florida, Texas, Wyoming.
And when they get there, they don't want an app. They want a real, live concierge banker who picks up the phone.
Bingo. You are not betting on interest rates. You are betting that wealthy people will continue to move to nice places with low taxes. It's a follow the private jets trade disguised as a regional bank.
And that's a really sticky deposit base.
Right.
Those clients aren't moving their life savings because the Fed cuts rates by a quarter point. You're buying the banking infrastructure for wealth migration.
And if that 2UniFi tech play hits, that's just a bonus.
It's the cherry on top.
Yeah.
A very valuable high-tech cherry.
So to wrap it all up, NBHC took its medicine Q4. It was a classic kitchen sink quarter to clear the way for 2026.
They're absorbing the Vista acquisition, which gets them into these incredible growth markets. 2026 will be the year of the grind high expenses. Lots of work.
But the prize at the end is a path to over $4 a share in earnings by 2027.
And while you wait, management is raising the dividend and buying back a ton of stock. The things to watch are that Vista integration and any news on a 2UniFi partnership.
This has been Talk Tickers. Keep your eyes on the tape.
See you next time.